2-year window. No lates in 12 months, nothing worse than 2 times 30 on installment in the prior 12 months. Well, those prior 12 months to the filing of the bankruptcy now affect the approvability of that loan, because if you have 3 car payment lates before you file the bankruptcy in that 12-month window prior to the bankruptcy, they will deny the loan because you have 3 times 30 on an installment. It used to be, and this was like a year or two ago, that if you included that debt that you were late on in your bankruptcy, it didn't apply to that rule, and they've changed it recently. So that's one thing that's gotten really messed up, and I'm very upset about that. So,
Alex, is that a hard and firm, fast rule?
it is something that I've gone to the top at FHA, and I couldn't get clarity. I was emailing HUD. No one can answer. I couldn't get an investor to get an underwriting manager to say yes. Can you? Probably, maybe. I don't know. I'm not going to say we can do it for sure, because it did exist at one point. So there might be an underwriter out there that still remembers it that way. It might close it. I just don't know the rule. HUD could not give me clarity. They said
I have one right now where the guy, his warehouse that he works at was shut down to about a 40% of his normal work time during COVID, caused him credit problems. Now he's been back full time, for 15 months since he filed bankruptcy, no problems since. But the problems on the mortgage leading up to that were directly correlated with the problem that's now been resolved.
Is there more than 2 times 30 on the mortgage?
Yep.
In the 24-month window?
In months 13 through 24, like you're talking about.
And do you have an approval with an underwriter?
Yes, but it's subject to the mortgage history being reviewed. But the question is, are they going to go back 24? And if it's related to the problem that caused the bankruptcy.
Is the mortgage reporting prior to the bankruptcy being filed on the credit report?
No.
You're going to get away with that, because they only ask for 12 months on a supplement. So if it's reporting on the credit report, that's where you're going to get burned. So again, this is a gray area. It's not something, it's something that I'm going to address every time I get one, and see if I can call around and get a bank to say, yeah, we changed it, or yes, we could do it. And that brings me to another one that I want to talk about with FHA that they recently changed. So this is another gray area. So let's say you're into this bankruptcy 4 years, and I'm telling you, you need a perfect payment history since you followed your bankruptcy payment, your credit, your mortgage, etc. Well, your mortgage for sure has to be on time in the last 12 months. They're going to verify that with a phone call. But if you were late on a bankruptcy payment early on in the process of the bankruptcy, and it's 3 years old, I now found an investor that will do it. I was being told that the whole life of the bankruptcy for FHA mattered, and now I'm being told it's only 2-year look back. The guidelines I've read said 1 year, so no one's doing 1 year. So that's another gray area, Dale. Have you run into that problem too?
Not recently, that one, but that's.
Yeah. So let's say this. So if you've been in the bankruptcy for over 2 years, it could be an issue. I'm going to call every time that you guys reach out to us. I'm going to make sure that the rule hasn't changed, or I can get an underwriting manager to override an underwriter. So what we do when these case by case scenarios is we will call the reps and ask, and they'll go to an underwriting manager, and the underwriting manager will put their stamp on that guideline. So when the actual underwriter, when we submit the loan, gets it, that will override the underwriter that's trying to say no, because we got an underwriting manager to say yes. So keep that in mind. That's how we kind of get this stuff pre-approved before we submit the loan. So let's go back to the FHA loan. So anyway, you want to be perfect on everything. If you're perfect on everything, we have none of these worries. If you do have some older lates, that are prior to 2 years, if 2 years clean on the bankruptcy payments, you got some lates prior to, give us a call. We can probably get it done. I got one right now in the pipeline, and it got approved. I called 6 investors. They all said no. One said yes. I said, get that in writing from the underwriting manager, and I got it, and it's going through. So you never know. That rule, it's a moving rule, Dale. That's how I look at it. That's how I put it. So when you do these loans, not only do we have to get approved from an underwriter, you're going to have to get approved through your trustee. So let's say I write you a pre-approval. Now I'm going to tell you, and then you go buy a house, and now I'm going to tell you have to go apply for your trustee to approve this, getting a loan. So what I have to do is I can't get it until we have an address. So if you're doing a refinance, I can send it to you right away. if you're purchasing a house, you have to wait until you go under contract because it's very specific to that house. So for example, they want an address, they want a loan amount, they want an interest rate, they want a monthly payment. If any of those things are approved and it turns out to be higher, if the loan won't close, you have to go back to that trustee approval process. So the process could take 30 days. So you don't want to start that over. So, excuse me. So what I do, I apologize. So what we do here when we send you these documents is we bump them up a little bit, increase the loan amount by $5,000, raise your taxes by $50 a month, raise the insurance estimate by $50 or $100 a month, quote a little bit higher rate. And the reason we do that, the reason I do that, is because anything could happen during the process. You could be in a flood zone, and what I didn't have that calculated my payment. If the payment that the underwriter's approving versus the trustee's approval, if the trustee's approval is $2,700 and my payment's $2,701, and there's nothing I can do to get it down another dollar, they're not going to close that loan. So if the trustee approves $2,800 and it comes to $2,500, I'm fine. If it comes in at $2,700, I'm fine. $2,750, I'm fine. So we try to get an approval. It's just a little bit higher than the actual prediction of what you think your payment is. And getting these payments right and the cash to closed right in the beginning is almost impossible. We don't know the exact property taxes. Yeah, we can look things up, but things change. Tax bills change during the process. The new tax bill just came out. Your insurance, yeah, you got a quote. We find out it's not enough coverage, or you're in a flood zone. Bam, there you go. Or we don't lock your loan right away and the market went against us. Or we find out you had a dispute and we have to remove the dispute, your credit score falls and the rate gets worse. So there's so many changing things during the process of the loan that it's better to err on the higher side. So that's why you need a professional who knows how to analyze all this stuff to see all these roadblocks before you get a pre-approval, because any one of these things will kill the deal. And it's just such torture if it's not addressed up front. So you got to be really careful of looking at the late payments, asking the right questions, making sure they pass the manual underwriting guidelines, but also getting these numbers right, these figures for your trustee, because a trustee doesn't like when you go back and say, hey, redo this one. It's not a happy moment. And neither the sellers don't want to wait around for another 30 days. It's just not a good thing. So that's how you do it. So not only you get approved by an underwriter, you get approved by a trustee. So let's assume you passed all the manual underwriting guidelines, you got enough money to close. It's from there on, it's a traditional loan. Do you mathematically qualify? Do you have enough money in the bank? And did the trustee approve it? So that's kind of how what we do. And it's very complicated. Go ahead.
I had a deal last year that going right down what you're talking about, where there had to be a rate that a number came in where the payment was $30 higher than what was originally submitted. And it had to go back to the trustee. We were lucky to get a quick response from the trustee because, like you said, you're approved at 2,700. I don't care if you're at 2,730. The trustee doesn't care what your debt ratio is. They got their own number in their mind. They want to see it.
Right.
So you're better off kind of probably pushing up the taxes and insurance and then bringing them down later.
Right. And if worse comes to worse, I mean, maybe we'll have you go out and shop for insurance and try to get a cheaper rate. Maybe we can buy your rate down. You come up with some extra money, we can buy your rate down so you don't have to go back to the trustee. But I don't like to do those complicated things because we made a mistake in the beginning. But if a mistake was made, that's one way to fix. There's ways to fix things. So just want to keep that. And when it comes to debt to income ratios, it follows exactly the same rules as our FHA manual underwriting rules, which we do plenty of videos on, but I'm going to give you a quick rundown. 31/43. So that's 31% mortgage payment divided by monthly income. 43% is adding your credit cards and car payments to your mortgage and divided by your monthly income. That's the first tier, just requires one mortgage payment left over in the bank. And the next tier is 37/47. And then the next tier is 40/50. You cannot exceed 40/50 debt to income ratio on any of these loans. So if your back end's over 50, there's nothing we can do. There's no exceptions. It's very strict. So that's the FHA manual underwriting rules. They combine in with the bankruptcy rules. Now, when it goes to VA, these are much easier. We can go to 65.
Alex,
yes.
Before you jump to VA, why don't you talk about somebody actively in a Chapter 13 doing a cash out refinance?
I was going to get to all that. So
okay,
it's the same for VA. So I was going to do the VA first and do how both of them. So
all right.
But basically, Dale's saying if you want to do a refinance and pay off your bankruptcy and get rid of that $2,000 a month bankruptcy payment, we can do that with a cash out refinance. The trustee has to approve it. I've never had any problems until this year with trustees. They're starting to deny loans. They don't want people, they're seeing 8% on these people's refinances, saying they're ripping you off, and rates are going back down now. They're like 7.25%. But a few months ago, I was putting 8%. They're saying this is too high. Even though the trustee's getting paid off, they can say no to this. So, but anyway, that rarely happens. The trustees don't want to get in the way of you getting a house. But they will get in the way is if you're trying to buy a house and they approved you with $1,000 a month rent, and now your new mortgage payment's $4,000. So that's called payment shock. And they're saying, we just blew out all your debt and you're going to go from $1,000 rent to a $4,000 mortgage. We're not going to approve you. But if you want to buy a $1,500 mortgage payment, they'll say, okay. So if you have $1,000 a month rent when you file the bankruptcy and now you're trying to get a $1,500 mortgage payment, that's okay. But when it comes to cash out, they generally never will get in the way because you're paying the bankruptcy off, especially if you're doing a 100% repayment plan, which is when you pay all the debt off, you're not blowing out any debt and you're making a payment on all the debt. A lot of people do 50% payment plans where they chop all the debt by 50% and then divide over by 60 months and you make payments on less. That's where maybe a trustee might be a little stickler because you blew out some debt and a year later you're refinancing and putting it all into your mortgage. And you kind of got away with something there, and they kind of like they're kind of onto that, but they still approve them. So don't count them out. They want to get these things done, and sometimes they'll make you pay the full amount back if you do it after a year. I've seen that before too. So
I've seen that too.
Yeah. So that's the FHA in a nutshell, and doing cash out to pay off your bankruptcy. A lot of people are doing that because inflation's killing everybody, and even though they're extending that thing over 30 years, they know they can refinance when rates get a little bit lower, but right now they can't afford that bankruptcy payment because inflation's killing all of us. So it's really good to do the cash out. Know that you're going to refinance it in a year when rates are lower. Hopefully, I'm kind of counting on it, and just get rid of that $2,000 bankruptcy payment that you have for the next 4 years. It's a great financial plan right now to get you through what I think is going to be a rough patch coming forward.
Alex, I want to add to what you just said. I mean, you talk about net tangible benefit. I mean, those homeowners out there, for the most part, housing values have held strong throughout all of this. The inflation and, the lack of available housing has kept existing homeowners' values up. So if you're somebody in a Chapter 13, you talk about the benefit of refinancing, even though it's to a higher interest rate. But when you factor in what you're paying off on the bankruptcy and your existing mortgage payment, more than likely you're saving a lot of money. Only to benefit in the future on refinances too.
Right.
Rate and term refinances.
All right, so that's FHA in a nutshell. That's purchasing cash out to pay off your bankruptcy. If you want to do cash out, they're probably not going to do it unless you pay off the bankruptcy because they don't want to see you get a windfall of cash and you still owe all these debtors. So I've never seen that. I've never tried it. Dale, have you?
No, exactly. They're going to want you to pay the bankruptcy off.
Yeah, they don't want you to have money in the pocket and all these debtors are waiting 5 years to get their payment plan from you guys. So that's not something we can really do. Now let's go to VA. Very similar to FHA in terms of the trustee approving it. There's nothing different there. The only thing better about VA is they only do a 1-year look back. You could be late on your trustee payment 13 months ago. You can have a late payment on your credit 13 months ago. You can have a mortgage late 13 months ago. They only look at 1 year. That's the best thing about VA. The other best thing is we go to 65 DTI. So on a manual underwrite. We like to stay below 55. Most of our lenders will do below 55. We just happen to have one investor that'll do up to 65. Not the best bank to work with, but they'll do it. So we can get it done up to 65%. So those are the difference between FHA and VA is the DTI is higher for VA and you can have late payments. They only look at 1 year. So you get late payments on the bankruptcy on anything else. It also doesn't have the same compensating factors FHA have. So if you're going to go 40 over 50 on an FHA manual underwrite Chapter 13, you have to have 2 compensating factors. Example, you have to have 3 months reserves in the bank after you close left over, and that cannot be gift funds. And you have to stay within 5% of your current mortgage payment or rent. So VA doesn't have that. All VA really cares about is 1 mortgage payment left over in your bank. Now, VA will sometimes want to see if you're going from $1,000 to $4,000 payment from your current mortgage is the new mortgage has gone up $3,000, they're going to want to see that you have maybe 3 months, maybe 6 months reserved because you're having such payment shock. They want to see that you have the ability to save money with that lower payment, because now you have this higher payment. If you couldn't save money before, how are you going to handle this extra $3,000 a month? So the more money you have in the bank, the more likely a higher payment than your current payment situation will get approved. Dale, you want to add to that?
Yeah, I wanted to go, I wanted to ask you something. I get this question every so often. Somebody who's actively in a Chapter 13 for 3 years versus somebody that was discharged from a Chapter 13 a month ago that was previously in it for the full term and paid as agreed. Is that looked at differently at all?
No. So the only thing so that's a good point, Dale. I'm glad you brought that up. So with all bankruptcy loans, VA or FHA, they're always going to look at your trustee payment history until you're 2 years discharged. So keep that in mind. If you're 2 years discharged, it becomes a regular FHA or VA loan. They don't even care what happened prior. Now, a regular FHA or VA loan looks at the discharge date to the 2 year window. If you're late after a discharge in that 2 year window, VA and FHA could deny that loan. That's a very bad thing to come out of a bankruptcy and be late and then apply for a mortgage right after that 2 year window. So 2 years discharge, you can go to any bank in the country and they'll do it because they don't, as long as you don't have lates in that 2 year window. But if you're currently in the bankruptcy or within 2 years of the discharge, it's called a manual underwrite, very unique loan. We specialize in those. So keep that in mind. Now, you brought up a really good point. This is really, really, really complicated. It's called a dismissal from the bankruptcy. I'm going to do my best to get through this one. So if you dismiss your bankruptcy, let's say you've been in it for 1 year and you dismiss it. If your bankruptcy attorney tells you to stop paying your bankruptcy and they'll dismiss it because he's lazy, then you have to wait 2 years from that dismissal because you failed to pay your bankruptcy on time. If you pay your bankruptcy on time up to the dismissal and you're dismissing it because you just want out of this program you got yourself into, I can do it immediately. So dismissing your bankruptcy is very crucial how you do it. So if you dismiss it because you can't pay anymore and you're falling behind and then you start going late, there's nothing you could do. You're going to have to wait the 2 year window from dismissal. But if you're optioning out of your bankruptcy, don't be late on your bankruptcy up until the dismissal because that'll disqualify you from getting a mortgage for 2 years for FHA and VA, I believe. No, VA is 1 year. So when you tell your bankruptcy attorney that you want a dismissal because you can't stand this $3,000 payment, you'll go back to paying your creditors. Make sure you pay your bankruptcy right up until that dismissal date and don't miss one of those payments and then you're eligible right away. Dale?
So to that point, so somebody's in the bankruptcy for, I don't know, 8 months and they don't want that $3,000 payment, like you said, and they want the bankruptcy dismissed so they can then go and pay each creditor individually.
Yes.
Any late payments, any late payments in there is considered almost a default on the bankruptcy itself, which is looked at in the eyes of underwriting. Remember, with underwriting, right, you are guilty until proven innocent as a default in itself, right?
Right. And if you've only been in it for 8 months, there's no question in my mind that 24-month look back at your payment history will all matter based on the FHA manual underwriting guidelines. So there's no way around it having more than 2 times 30 on anything in a 24-month window on an installment. So remember, if you're less than 1 year in that bankruptcy, you dismiss it. That bankruptcy payment has to be on time, but also the debt going into that bankruptcy now matters, what you're late on. And there's no way around that. So once you're dismissed, you can't we're not going to be able to find a bank out there that might say, hey, if it's included in the bankruptcy, we would exclude it. That rule does not apply. Because
Alex, for some bizarre reason, if somebody got an approved eligible with the bankruptcy, we got to explain to everybody it's an automatic downgrade to a manual underwrite with an active bankruptcy.
Yeah, it is. And I've had underwriters get you have to run the findings, you submit the loan with the findings. I have approved eligibles. I'm like, I don't know how this happened. And the underwriter misses that it's a manual. And I have to remind them, hey, you want the trustee approval? You forgot to ask me for it, and because you don't want your investor stuck with the loan. So you got to remind them sometimes. It tricks people. It tricks the underwriters.
That's another important thing is even if an underwriter forgets something along the way, they could still come and ask for it in the 11th hour, and they will. They absolutely will. So that's where we're going to help you.
You never want to plan on a mistake made by an underwriter is going to make it all the way to the end. You want to be prepared that you pass all the tests. It's nice when they do, and they don't terrorize you, it's always nice.
How about when you're, yeah, but you don't want to be at the closing table and then they're asking for one more thing
Right.
that they didn't ask for 45 days. And
That
that happens, unfortunately.
That reminds me of another thing. When you're doing a bankruptcy loan, these title companies at closing tables need document from the trustee saying it's okay because there's a lien on your title. This is a bankruptcy. So we have to get that to the title company when you're at the closing table. That happens a lot. You find out, the file's not closing because the title company found out there's a bankruptcy. You have to show that the permission to the title company now, not just the underwriter. So there's always something in this business. You got to fight these loans all the way down to the end. So that's why you want a professional like me and Dale. We specialize in these loans. This is what we do best. There's no question about it that we're one of the leaders in this country with these types of loans. And that's what you want to go to. You don't want to go with a rookie because he heard that you can do these loans and there's not a lot of business out there. So he's ready to learn this. You don't want to deal with something like that. Make sure
this is a process that you don't learn overnight. Unfortunately,
yes.
we've got the bumps and bruises and scars from this process of learning it. It's just, there's no easy path, but we've been down the road many times.
Yep.
Alex, I think there's a question I just saw it pop up.
So Mitchell Hutchin on YouTube. What if you get behind on the BK payment, but you caught it up with a lump sum payment and been on time ever since? So that's where you're going to fall into either if you're a veteran, they're only look at 1 year look back. So you have to be a year out of that last late payment. FHA, you're going to have to be 2 years away for us to even have a chance if we can still have an investor that we can find at that time, in that moment in time when you're going through the mortgage process, that will accept that. Right now, I have an investor. So if you're 2 years away from that last late payment, and when you caught up, I can do it, but you cannot do it until you clear that 2 year window for FHA or the 1 year window of clean payments for VA. So if it recently happened, you've got a waiting period.
Alex, I have a question.
Sure.
I'm sure you've seen this too. Somebody on let's say bad advice of an attorney initially files a Chapter 7, then they immediately do a U-turn. There's a dismissal of that 7 and they go into a 13. Have you seen that?
Yes. So there's a lot of.
And does the underwriter look at that individual adversely because of the series of events there?
I wish I knew this before I wish I could have studied this because this happens. There's some type of Chapter 7, Chapter 13, back-to-back reason to do that. And in that case, it's okay because it can't be something that you were derogatory on after the 7, so you follow the 13. That's no good. But if there's a reason that something couldn't be discharged in the 7 and it had to be put on a payment plan into a 13 right after, and it was one big package, you can do those. But if you're going into that chapter, if you're coming out of a Chapter 7 and you go late on a credit card right away and then you file 13 on that, that's going to disqualify you in so many different levels.
Yeah, it's a problem. Yeah.
Yeah, it's going to disqualify. So there is a unique situation. I don't know what that can't be discharged, but it can be Chapter 13. So people are doing 7s and then back-to-back 13. I don't know that off the top of my head, but I've seen it and it's okay for very unique situations.
Well, like you said, it's unique. A lot of this stuff is case by case. There's a general foundation of things that we follow on these deals. Right. But sometimes you get really deep in the weeds on something like that, and you really got to either talk to the underwriter, or a lot of times the underwriter's not sure, and we go up to the underwriting manager.
Right. But hey, I always tell my clients when you're doing these bankruptcy loans, try to save as much money as you can. The trustee doesn't want to see you save money, but try to save money because money always gets you through a lot of the tough conditions, like a VA manual, a Chapter 13 with payment shock. You got money, underwriter's going to be okay with you getting a bigger house. Right now, everybody's got payment shock. So the more money you have, the better it is. When you're going through these manual underwrites, if you got money in the bank, the underwriter likes the fact that you can save. You've no lates, you got some money in the bank. It makes underwriting go through so much better. So
I'm going to add to that. That makes such a difference. If your mortgage payment is $2,500 a month, or your proposed mortgage payment, and you at least have one payment, preferably 3, but let's say 1, that makes a big difference in the eyes of the underwriter.
Yeah, I've noticed with these loans, if you got like $100,000 in a 401k, they're nicer to the loans that people have just one mortgage payment, which is the guideline, let's say. When you got more money, the underwriter doesn't condition as much of the file because they see that you have money if something were to happen. What they're looking for, their license is on the line. If they write this loan and it goes bad, and then their company overlooks why it went bad, why did you approve this loan? They had no money in their bank and they just deposited their VA disability check the day before closing, and now you have reserves, but they really didn't have it. They're living check to check. Why did you approve this? Oh, I don't know. But you got $100,000. Bam, I'll stamp this one all day long. So the more money you have, the better it off is. Now, you by your bankruptcy laws, you can't save 100 grand in the bank. They're going to want a piece of it. So there's a delicate line of how much you're supposed to save, in your bank, because the more you save, the more the bankruptcy attorney is going to want a piece of that if they catch wind of it. And supposedly every few years they'll do an update on assets and income to make sure that maybe you're not making more money. They want to increase your payment. So there's some times where they can call for your bank statements and your paycheck stubs just to update the file. So that's how they're going to catch it. Any other questions? Dale, you got anything you want to add there?
Yeah. If anyone does have a question, whether it's now or later, you can always contact us on the Gustin Show forum. Can you give the details of the forum, Alex?
Yeah, Angela will put it in the comment section. She'll add the forum contact and our website. It's and our website, and anybody out there, please like and subscribe to us. It helps us help you. This is our specialty. I want to keep reiterating this, that this is what we do. And if there's any bankruptcy attorneys out there, please call us. We can help you sell your bankruptcies. Imagine if you could tell your client in 1 year they can buy a house if they do this. How many more sales you can have. And they get me on the phone to help you sell your own bankruptcy plan and say, I can do this loan. And then put one of my videos in front of them. And they say, okay, I'll go bankrupt. Sometimes bankruptcy is not a bad thing. It's not so bad if there's no other choices for you. And I think going forward, we're going to see an increase in bankruptcies. And I don't want people to feel like if I do this, I can't do anything ever again in my life. That's not true.
That's not true.
In 1 year.
Yeah.
You're going to get credit cards thrown at you. There's a lot of things that happen when you go bankrupt. It's not so bad. When I was younger, I used to thought bankruptcy, oh my God, that's horrible. If you do it once in your life, it's not a bad thing. You're going to give a second chance. Just make sure you pay everything on time. You get a second chance. That's what this life is about, second chances.
Well, my dad didn't give me a second chance when the teacher called home from school when I was in grammar school. The teacher was always right.
The banks are nicer than Dale's dad. We give you a second chance.
No, hey, all kidding aside, if you're a buyer, you're actively in a 13, you've seen this video, and maybe you got a change of opinion now, you think you may qualify. Not only will Alex and I review your loan, we can also send it into an underwriter, without a property to officially get underwritten to give you the reassurances that you can qualify.
Yep.
That's all for me. Happy Thanksgiving to everybody.
Yeah, thank you guys again. Like, subscribe. Happy Thanksgiving to everybody. Please call us. We can help you. Thank you guys.
Alex, what's your favorite part of Thanksgiving? Is it family, food, or football, or all three?
Football. I love my family. That too.
All right.
Thank you guys. All right.
Take care. Bye.
I have an underwriter that called me on a loan. Hold on.
Great job.
That was good?